Hi everyone, Jim Lorenzen here, and today we are going to be talking about guardrails. First, let me give you a full screen here so you can see everything really a lot easier. There you go. Today, we're going to talk about guardrails because people don't want to see their retirement go off the road. You know, during the days we were accumulating money and putting money into our 401ks, it was pretty simple. You put money in, you have a good allocation, and you watch the markets over years take you up, and it was all much, much easier. Retirement is very different because the income is stopped. You're no longer investing. Now you're draining assets. And the real question is, given the tax law changes that will happen over the coming years, all the things that we cannot predict, how do we make money last and yet still have a decent lifestyle without denying ourselves too much? So no one wants to see their retirement go off the road. And that's why we're going to be today talking about guardrails and the guardrails approach. Okay, first, a little bit of legal stuff we'll get out of the way. First, remember, this is not advice you're going to hear today. It's not legal advice. I'm not an attorney. It's not tax advice. I'm not a CPA. While I am a registered investment advisor, this isn't investment advice either. It's information. You might find it educational. I hope so. But I can't give advice to anybody without knowing their complete financial picture. Also want to give a shout out to the Franklin Templeton Group for providing some of the graphics that I had requested from them. And it was always good to get it from them. The Franklin Templeton Group and the Independent Financial Group, my practice, are not affiliated in any way. But it was nice of them to be able to provide the information I wanted. Okay. Let's move forward. Here's a little bit of background on me. I'm not going to spend much time on this. If you'd like to learn more about me and what we do, there's a couple of ways to do that. We'll talk about that later. The website's down at the bottom of the bar, at the bottom bar there of the page, infin.com. It's enough for you to know for the moment that I've been doing this for about 30 years. I'm a certified financial planner. I am an accredited investment fiduciary, and I've written a lot of articles and I've done a lot of stuff in business and yada, yada, yada. So much for that. Okay, let's talk about the four big concerns. These are the most common concerns people usually voice in most surveys, both the Franklin Templeton and also their surveys that, I shouldn't say formal surveys, but they're the things that I hear about most. And I think talking to a lot of advisors, it's what they hear from their clients too. The big core concerns are longevity, inflation, taxes, and volatility. In other words, longevity. I don't know how long I'm going to live. I want my money to certainly last longer than I do. I don't want my life to last longer than my money does. Inflation, that erodes purchasing power. Taxes, tax law changes happen all the time, and it's Uncle Sam, your partner in life, deciding how much of your profit he wants to take every year, and you've got no vote. And then there's volatility, and we're going to see what volatility can do too. Every year, Franklin Templeton does conduct a survey around retirement income strategies and expectations. And when they're asked, what do you think pre-retirees say the top concern is? You probably guessed it, running out of money. Pre-retirees fear running out of money more than out of health problems, more than aging. Some people, believe it or not, fear it even more than death. Unstable markets add to this fear, particularly during times of high volatility. Let's take a look at why. Now, this is something I put together a long time ago. I'll bet you I put this together maybe 20 years ago. I don't know. It's been a long time. I wanted to show what effect volatility has on a portfolio. Now, we have basically, I just created a number here, $500,000 as its starting value. And with that starting value, I created three different return series. Now, all three return series average out to the same amount, same return. Compounded 11.6%. You can see down there at the bottom. All three return series are 11.6. The first series starts out with high returns, ends up with low. All I did was reverse the order for the second series. Start out with low, end up with high. Same returns, just reversed them. And of course, the third series, I just made every year 11.6. Now, the 11.6 doesn't mean anything. In fact, none of these numbers really mean anything. I want you to, don't put any emphasis on the numbers. The important thing is the concept. recognize that what I did here is I just created these returns with $500,000 and did the computation to figure out what the return was. It just happened to come out to 11.6. Doesn't mean a thing. Okay. So, but you can see as long as there are no withdrawals, savings or withdrawals, the end result at year 10 is identical. It doesn't matter what returns do as long as they average 11.6. Now, that's why the investment period, the accumulation period, was a lot easier, because all you had to do was just wait it out. And if you averaged a certain amount, it wouldn't matter what the order of returns were. But what if you had to take money out of your account in retirement with that $500,000? If the returns average 11.6, it seems to be common sense that if we were making 11.6 on average, you could take 11.6% out every year and still end up with, a decent amount of money. Because after all, you're only taking out the returns. Well, 11.6 is $58,000. And you can see here under the first series, when we started out high and ended up low, we still ended up with $803,000, even though we were withdrawing that 11.6 every year. In return series 2, we started out with low, bad returns and went to high. Look at this. Same withdrawals, same average annual return over 10 years, but now you've almost run out of money. Now, the third scenario, 11.6 every single year, means we had about the same money. And the only reason we didn't is because you're taking money out the first year before you had a whole year of returns. But nevertheless, it came out about even, which you'd expect, 11.6 in, 11.6 out. These first two tell you the importance of the order of returns, though. There's a risk. It's not just what returns you achieve when you're withdrawing money, it's when they occur. The order of returns can make a difference between making money or losing almost everything. Very important understanding. So, there are 4 concerns, all right, but there's one more. The safe withdrawal rate. What is a safe withdrawal rate? How much can you take out? Well, when I went to consultant school, I had to stand up in front of the class on day 1 and learn and repeat lesson number 1. To any question, it depends. So today we're going to talk about the number 1 concern about retirement. And we're going to talk about what was memorable about 1966. And we're going to talk about how small adjustments can make a big difference by putting in those guardrails we talked about. Now, many of you know about the 4% rule. That's the safe withdrawal rate that has been propagated for many, many years. It may not seem like it's rocket science to say, well, you take 4% out every year, but actually it took a rocket scientist to come up with the idea. It was William Bengen. He graduated from MIT with a degree in aeronautics, and guess what? He became a financial advisor himself later in life. In the early 1990s, he began to research how much money someone could safely withdraw from their savings without running out of money. And he was poring over all this historical market data. One year came up and just hit him in the face. And it was key to his development of the 4% rule. And that year was 1966. Now, what do you remember about 1966? By the way, the man in that picture was not William Bengen. I don't know who that was, but nevertheless, it was a good picture anyway. Okay, what was memorable about 1966? Well, you saw Doritos. It was one of America's snacks, and that's when it was introduced. It was also the year Chevrolet released the Camaro. Remember that? And James T. Kirk, who recently went into space himself, and the crew of the Starship Enterprise made their debut on the original Star Trek television series. And the top song of the year was I'm a Believer by the Monkees. Now, you might not know what William Bengen discovered in his research, but 1966 was actually the worst year for someone to retire. You see, the success of a retirement income strategy can be significantly impacted by when it starts. As you remember our charts before, we showed the order of returns, when it happens, when bad things occur, can make a big, big difference in outcomes, even if you don't change your withdrawal rate. So let's look at a standard investment strategy. Let's assume a retiree has $1 million in a retirement portfolio. It's invested in 60% stocks, 40% bonds, and he's going to start an annual withdrawal rate of $50,000 a year and increase it 3% each year. $1 million, 60-40 stock bond, 50,000 withdrawals going up at 3% a year. If he retired in 1966, here's what would have happened to his money. After 29 years, it would have gone to zero. That's not a good thing. And you think, well, 29 years that's a long time. Well, not so much anymore. My own parents lived 32 years in retirement. I would have hated to have thought the last 3 years what it would have been like if they'd have completely run out of money. But let's say we use the exact same strategy, but instead of starting in 1966, we start in 1967, just 12 months later. Same money, same strategy, same withdrawal, everything. And you can see the money that ran out in 66 and 67, 1 year later, and it funded a retirement while the investments doubled. So the order of returns, the timing of returns make a big difference. But the problem is, of course, who can predict what a good year is going to be in advance? Nobody can, really. Even those gurus on TV who tell you they know what's happening, they don't. Nobody does. So what happened? 1966 was not associated with any financial calamity. No Great Depression, no dot-com bust, no global financial crisis, no COVID, none of that. So the 1966 return over time turned out to be minus 4.58%. Now, it wasn't really good in 66, by the way. I don't mean over time, but in 1966, that was the return. It didn't seem all that bad. I mean, would you have thought it was catastrophic? Of course not. Of course, it probably turned out that way. But early negative returns get compounded into future years of retirement. Along with increasing withdrawals in a volatile market in the 70s, well, the strategy never recovered. It's an example of what we call sequence of return risk. A poor sequence of returns can set a retirement income strategy down a path from which you can't recover. And you can see the account balances kind of mirror each other over a period of all these years. They almost mirror each other without deviating quite a bit until all of a sudden the withdrawals begin to have a huge impact. Fortunately, making small early adjustments to a retirement income strategy can make a big difference. Using guardrails can help with this. Guardrails are rules. They're triggers that guide a retirement income strategy, and they'll help you stay on track. A protective or a downside guardrail aims to keep a retirement portfolio balance from dropping too low, because if it gets too low, it won't support future withdrawals. So a common protective guardrail says that in years when a retirement portfolio experiences negative returns, no increase in the annual withdrawal amount is applied the following year. Very simple. You get negative returns, you don't take your cost of living increase, that 3% increase the following year. And for most people, this makes sense. If you have a bad year, you don't increase how much you spend. Hold steady. Maybe you might even tighten your belt a little bit. If you had applied the guardrail approach in 1966, all of a sudden that would completely change the strategy for negative years. You can see what happens. Perhaps more importantly, using guardrails with this strategy doesn't require any dramatic reductions that otherwise might have been necessary. In fact, while annual withdrawals were flat during the poor years, there were no cuts in the income generated. In fact, it still almost doubled over time. The income did. But 66 was a long time ago. Let's look at how this protective guardrail might have worked more recently. Most of us know or recall that 2000 was the year of the dot-com peak, just before the big collapse and the recession that followed. Someone retiring at the beginning of 2000 was certainly exposed to a poor sequence of return beginning with that retirement. Using the same strategy we did before, you can see that the annual retirement account balance has declined over the years, similar to what happened in '66. But looking ahead, this strategy may struggle to support annual income withdrawals, and difficult adjustments may be required. You can see the protective guardrail would have significantly improved the account balance. There are many different criteria you can use to construct guardrails. For example, someone who retired at the start of 2000 and watched the assets immediately begin to drop might have decided to, say, reduce spending. Someone using a more conservative guardrail, one that cuts the annual withdrawal rate by 3% in years when the portfolio goes down, would have actually had more than they started as of June 30th of 2020. Well, let's review. Guardrails can be put into your retirement income strategy, and they may help offset poor returns early in retirement. They emphasize small, incremental changes to an income strategy, which may be easier to tolerate than the larger, more disruptive changes. And guardrails can be changed or adjusted to fit your specific circumstances, even if you're already retired. The earlier a guardrail is put in place, the more impact it has because of compounding. Now, if you're interested in adding guardrails to your retirement strategy, you probably should be working with someone who also knows your entire financial picture and can help you, give you meaningful input. Remember, retirement is wonderful if you have two essentials: much to live on and much to live for. And that's why it's important that you're here for this webinar, because it's obvious that you're one of those people who wants to take steps to make sure you're prepared. Most of us think of just one risk of loss. Whenever we think of investing in the markets, we think of risk of loss. That's just how we're programmed, because we're told that by all the gurus on TV. But it's only a loss if you're forced to take the loss, if you're forced to sell to take money, which of course happens all throughout retirement. But losses can occur, obviously, for a variety of reasons. There are many of risks, and they all have to be managed. There's inflation risk. Money loses purchasing power. You can put dollars in a coffee can in the backyard, and they'll lose by, well, according to this year, it's almost 5.96%. There's, and of course, by the time, you turn off your, you turn off the webinar, that may have gone up or down. There's legislative risk because tax law changes. Things cost more at the store, and the government takes more of your money out of your income. There's market risk, what we all know. There's business risk. Business risk is inside of market risk. Businesses out there that may have competitive issues, whether it's from foreign or domestic, that can cause prices to go down. And that may not be a systemic market risk, but the business risk incurring inside the market can have an impact. And of course, there's interest rate reinvestment risk. If interest rates are going down, you're reinvesting bond money at lower rates. If interest rates are going up, you're obviously reinvesting at higher rates, but you have to wait for bonds to mature. You can't sell them early because with interest rates going up, bond values decline. And that's what happens all the time. So here are some takeaways, things I want you to think about, and there's some things you may want to consider reviewing with your advisor. You have to understand what can and cannot be controlled. And you have to understand retirement can last 30 plus years for 2 lives. And the second and third decade of inflation and taxes could be much higher. Now you'll notice, while I've listed quite a few things to think about, and the takeaways for you here, some of these I've emboldened. And I've done it because they're kind of worth some serious looks. Incorporating Social Security planning into your total plan is very important. Most people just automatically go down to Social Security, they file, they get their money, and they think that they're done. The truth is, your choices can have a significant impact on your future and your future taxes, as well as your Medicare premiums. There's more information on this. You might want to look at our website. It's on our Social Security page, infin.com/Social Security. You can get more information there. Also, you might want to include Roth conversion planning into your total plan because of legislative risk. Sequence of returns, we already talked about that today. Your plan should test for various safe withdrawal rates. And don't forget, health and long-term care usually go up, if the past is any indicator, at about twice the inflation rate. And you want to be able to coordinate your time segments in life with your goals and priorities. Remember, diversification is about volatility correlation. It's kind of a big phrase there, volatility correlation. That means different asset classes move in different directions at different times, and some of them at the same time. It's correlation that determines how volatile a portfolio is. It's not about spreading money. It's about managing correlation of movements. Now, we diversify risk, not money. We just do it with money. And to find out if you're on track, it's like walking into a mall. If you want to know how to get to a certain store, you have to look for that thing that says you are here. You have to know where you are right now. Now, if you're one of those who'd like to get started, you can do the right thing and go to our website, infin.com. You can go to our Getting Started tab. And at that tab, you'll see you'll see a URL and everything, the things you can click on and go with. And basically, that's where the protocol is for you to get started. And if you'd like, you can arrange a Get Acquainted Right Fit phone call with me, where you can share my computer screen and you can learn about what I do, how I do it, and learn all about IFG and what we're all about. At any rate, I thank you, and I hope you were able to benefit from a lot of things we talked about today, and I hope we can maybe talk on the phone too. Thank you very much. Take care.